Hello, welcome to Capital Market Live on Channels Television. I'm Ladi Williams, and it's time to summarize all that happened in the markets this week. Starting with the global market, we see European stocks finish high on Friday despite an earlier dip as market participants reacted to stronger than expected U.S. jobs data. The Pan-European Stock 600 index closed up 0.88%, while the DAX there was up 1.06%. The FTSE that rose 0.58% to close on Friday. To Asia now, we see Asia Pacific stocks were mixed as investors look ahead to the U.S. Jobs data work that could set the tone for the Federal Reserve's next move for interest rates, and the index was last trading 2.1% higher. We see Asia stocks already reacted to that jobs report there. We see the Nikkei that was down 0.26%, 30,994 points. The Shanghai Composite that was at 3,101 points, 110, and that was up 0.10%. Hang Seng Index 17,485, up 0.10%. So we'll see it was quite mixed there, mixed picture. That's what we got in Asia. To U.S. markets now, we see U.S. stocks rallied on Friday even after release of stronger than expected U.S. jobs data and a pop in Treasury yields. The Dow Jones Industrial Average gained about 288 points to 0.87%. While the tech-heavy NASDAQ Composite rose 1.60%, closing at 13,431 points. The U.S. economy added 336,000 jobs in September, according to the Labor Department. Well, to drill down on all of this data and what happened in the U.S., I have joining me now Olumide, additional financial market analyst. Hello, Olumide, great to have you.
Yeah, good evening, Ladi. Thanks for having me.
Fantastic. So tell me, what factors contributed to the rally in stocks on Friday, and how would you term the week so far for U.S. markets?
It's been a mixed week. We're coming from record sell-offs in the month of September, and the first week of October seems to be oscillating towards that. But what we saw on Friday was, despite the uptick in U.S. non-farm payroll that even doubled economists' estimate, the market seemed to rally strongly on the background that the U.S. Treasury yield moderated from the 16-year high, and we saw the U.S. dollar index losing about 20 basis points. So that really gave the bulls much more ammunition to really hamper on buying pressure. And also, you look at the technical moving average, it shows you that the U.S. stock had been in an oversold position, so definitely it needed little triggers. And with oil prices also on moderation for a while, I think that concern about energy inflation, which really plays a major role in the U.S. CPI, was really helpful. So that's one of the reasons why we saw such rally. But I think the big gainers for the week was Facebook, Meta, because Meta reported that they were trying to close down their the loss making division. That's the metaverse, and definitely that really showed the stock rallied for the week about 5%. Google also was up 5%, Visa up 2%, and let's not forget Microsoft also about 4%. So definitely that really pushed the buy. But concerns about the financial situation, the government shutdown, the U.S. bond market, record sales, with the long 10-year Treasury bonds really affected financials. So stocks like Berkshire Hathaway had finished negative for the week, and we saw Bank of America finishing 52-week low. So that really triggers that while we see tech stocks really shaking up from the sell-offs, financials are not doing so well.
Right, and definitely I'm wondering when that metaverse narrative is really going to catch on. But talk to me now about the significance of the U.S. economy adding 336,000 jobs in September, especially when economists had anticipated a much lower figure of about 170,000.
Yeah, when you look at data, it's rock solid, but when you break it down, you see that most of the upsides were part-time jobs. But pretty much, it tells you that the U.S. economy is quite robust, firing on all cylinders, and compared to many markets like the Europeans and Asian markets, definitely the U.S. market is the stock to beat, and that really showed on the currency. The U.S. dollar has been rallying against major currencies. since July, and really pushing the British pound to monthly lows. So I think it tells a lot about how dynamic the US economy is and how diversified, despite the political uncertainty. The speaker was removed, and the fact that government shutdown had also really created some panic in the markets. But if you look at stellar indicators, US economy is much better than what we're seeing outside. Critics will tell you that the debt exposure of the US economy is really another concern. But one of the main things about the United States is that their debt is denominated in the US dollar. And if you look at US Treasury bond market, despite record sell-offs coming in, the yields has made it very attractive and that increased the cost of borrowing for frontier and emerging markets like Nigeria. So I think the US market seems to be burning on all cylinders. The only concern is that, most of the US companies like Apple, Microsoft, Google that have exposure in different markets might suffer in the next quarter because of the strong dollar, which might really weaken their profit margins. But apart from that, I think the bets are with the US post.
In markets next week, any market moving data?
A lot. In fact, I think what investors will be looking on is the body language of Fed officials. Though we are 3 weeks away from the all-important Fed meeting coming in November 1, I think the producer price index coming on Wednesday will show how price changes have been in terms of domestic on the domestic side. But I think the big elephant in the room is on Thursday, where we see the CPI. That really would be push on the narrative of how the markets will react. Any strong number from that, I think probably is going to be a red month in the month of October. But we see a much more reversal, an huge inflation differential. Maybe the bulls will keep running. But right now, the market wants bad news because it's only bad news right now that can keep the US Fed away.
There's a lot of bad news going forward. Thank you so much, Olumide, additional financial market analyst. Thank you so much.
Yeah, thank you for having me.
All right, let's bring it back home now. See, the Nigerian Exchange Group was quite busy this week with the listing of investment company VFD Group on the exchange. The VFD Group is a proprietary investment focus, meaning it invests in target companies for direct market gain, unlike investment banks who invest on behalf of others. According to the management of the Nigerian Exchange Limited, listing on the exchange is not an easy task, and he commends VFD Group for their patience. Take a listen.
I'm delighted to welcome the VFD Group to the main board of the Nigerian Exchange Limited on the occasion of his listing as a quoted company on Africa's second largest exchange. We are targeting the first, inshallah. The listing opens up access to the deeper levels of financing available on the Nigerian exchange and will give the VFD Group greater visibility in Nigeria and globally.
Process of listing on the exchange is not an easy process. It can be quite arduous and quite demanding. And we're extremely grateful that they stuck through the process throughout and really demonstrated this, I think, opportunity to us that they're strong partners, strong supporters of the exchange, and we're very, very grateful for that. We're very delighted. People ask me all the time, they say, well, there are not a lot of tech companies on the exchange. Now, whilst VFD, as we'll find out, is not just a tech company, it's more than tech. But as I look at all the listed companies on the exchange today, they're probably the closest to what you would call fintech on the exchange. And I think it really represents a big day for us.
Meanwhile, trading the week ended Friday, October 6, 2023, saw the Nigerian equities market rose by 0.11%, and as investors bought banking, consumer goods, stocks. In the latest market update, there was a significant surge in trading activity as a total turnover of 2.41 billion shares valued at 22.11 billion changed hands in 27,965 deals. To the sectoral performance, banking closed the week up 1.43%. Consumer goods at 0.17%, while industrial goods was down 1.38%. Insurance was also down big there, 3.11%. FTN cocoa processors topped the gainers counter for the week, up 19.21%, while Consolidated Hallmark Insurance PLC topped the losers counter, down 19.05%. Well, joining us now for analysis is James Oladisa, financial analyst at Chapel Hill Denham. Great to have you on the show. Hello, James. You might have to unmute. You might have to unmute. I can't hear you at this point. Hello, James. Let's try it again.
Yes, can you hear me now?
Fantastic. I can hear you now. So, yeah, it was a holiday. It was a holiday shortened week. The local bourse did manage to eke out a gain there. How did you see trading this week? Do you think investors are still on that profit-taking sentiment?
Well, just a breakdown of the market, the bear and bull tussle. We saw the bulls dominate. The market closed in positive terrain. ASI was up 11 basis points. Attribution analysis indicates that names like Airtel, Boa Cement, GTCO, and Dangote Sugar, contributed most of the profits that we saw in the equities market. In fact, together, all four names contributed about 86% of the gains we saw in the market. And I think it's noteworthy that all the names come from various sectors, so the gains were broad-based. On the flip side, we saw that some names partly offset, the gains that were accrued from selling pressures in Danksem, MTN, Nigerian Breweries, and WAPCO. So on profit taking, yes, we saw some investors, take some money off the table. However, the profit taking was matched and surpassed by, bargain hunting, as investors, looked for fundamentally sound names with cheap valuation to pitch their tent. There was also an element of corporate action in the industrial sector. We saw Boa Cement come out to, slash ex-factory prices to around 3,500. And the market reacted positively to that, largely because, it might offer some form of relief in a time of rising prices. However, the reaction of its peers, in my view, would largely dictate, who stands to gain or lose. And this should be what would guide investors on how to pitch their tents in the industrial sector.
Right, and we did get that listing this week, talking about the VFD group. How did that, shape sentiment in the market? Did it shape investor sentiment in any way this week?
I mean, there was no marked, increase in the ASI, as I've pointed out, with the 11 basis points gain, right? But, we saw a lot of value being traded, and, that sort of speaks to investment or trading activities in the equities market. So, yeah, in some way, I would say it sparked, interest in that front.
Right. Talk to me about stocks that stood out for you for the week, sectors, and why.
So I think the fact that the banking sector gained 143 basis points, outperforming all the other major sectors on the NGX is quite instructive. A lot of the buying interest came from tier 1 banks like UBA, GTCO, Zenith, Access. The positive sentiment around the banking names, as we know, has been a result of valuation gains, which investors believe could possibly benefit them in the future. And also from a valuation standpoint, except for Stanbic, most of the banks are trading at a price to book below one times, and that's cheap valuation, and it makes it ripe for picking by investors, and that makes the banking sector quite attractive.
Tell me, what are you expecting for the market, next week? Any market moving data coming right here for the local bourse?
Well, so, last week, or this week rather, we saw sell-offs in names like MTN, Lafarge, Danksem, and FBNH. And, that provides an entry point for new investors, who are looking to get into the equities market. I see that what's going on among the cement players could also spark some market action next week. If any of the other cement players, come out with a corporate disclosure. Now, based on the NGX release calendar, we're also expecting some corporate action around the tail end of the week, and this could possibly be a catalyst, for market action, next week. Apart from that, we anticipate that, routine activities will continue as usual.
Welcome back to Watching Capital Market live on Channels Television. I still have with me James Oladisa, financial analyst at Chapel Hill Denham. Thank you for staying on. Hello, James. Okay, we'll try and get James back on. I don't know if you can hear me, James, but we'll try and get back to James. Now, let's take a look at what happened with the unlisted securities. Now, we see was positive sentiment was also seen with the unlisted equities market. The NSE OTC index and market value appreciated by 0.48% to end the week. And we see the total volume traded in the week was 12.67 million units, leading to a 386.18% increase in NASD trade volume. There was also a 6.606% increase in the total value traded during the week, as NASD investors traded about 55.63 million naira. Central Securities Clearance System PLC led the top gainers for the week, while Food Concepts PLC led the losers counter for the week as it topped trades by volume due to sell pressure. All right, let's get back to the conversation now. I think I still have with me James Oladisa. Hello, James. Can you hear me now?
Yes, I can hear you. Can you hear
Fantastic, fantastic. Great to have you. I can hear you.
Great.
So we got that capital importation report. We see from the NGX also, there's a report that domestic and foreign portfolio participation in Nigerian equities market showed that foreign portfolio investors are disinterested in the country, as the equities market recorded a net FPI deficit of 32.3 billion naira. That's for the first 8 months of 2023. How are you seeing this?
Well, so the trend isn't new to us. In 2011, till now, we've seen foreign participation drop from around 67% to 9% if we look at it on an annualized basis, based on the performance in 2023 so far. While charity begins at home, domestic participation has increased significantly. The apathy of foreign investors to the Nigerian market, is not really a good indicator. And their distance from our market is largely, a result of two factors. One of which is risk of sentiment. So, if we look at the advanced economies like the US, it's currently trading at around 5.4%, right? And so in terms of risk, foreign investors would rather reduce their exposure to risk, which in this case would be the Nigerian market, investing in, the treasury instruments. Secondly, our FX backlog, which is estimated at $10 billion, is indeed a challenge, right? So some foreign investors have not been able to, repatriate their funds, and this poses a significant risk to foreign capital. Now, if we look forward, we see that there's possibly some inflows expected into the country. There's $3 billion expected from Afrexim, about 1.5 billion from the World Bank. Is expected to strengthen our education and health sectors, right? And that's roughly a total of 4.5 billion, right, of fresh FX inflows, and that could possibly, give us some relief on that front, some FX relief, and, put us on track to clearing our backlog. Secondly, in order for us to attract foreign investors, it's possible for us to offer attractive OMO rates as a way to attract these foreign portfolio investors. We've had one OMO auction this year, around August, and it's beginning to look like it's just a one-off event. However, the pricing at the auction of the one-year paper was, we had an effective yield of around 17%, and that shows promise. So offering foreign investors yields that could possibly earn them, a positive real return, could possibly whet their appetite, and, bringing them back would mean that we would possibly see some of the inflows, filter into the equities market, but we recognize that there's a risk to this, or there's a downside to this, which is the fact that, offering attractive yields would mean that, the government would have to spend a lot of money to service its debt, and that will have an adverse impact on the growth of the economy.
Right, and still talking about, you know, the NGX being busy this week. We know they admitted the Nigerian Infrastructure Debt Fund, a 200 billion naira public infrastructure investment fund by Chapel Hill Denham. Tell us more about this.
Yeah, so the Nigerian Infrastructural Debt Fund seeks to address the infrastructural deficit in Nigeria. You know, over time, we have consistently emphasized the need for infrastructural development within Nigeria. You know, and this fund is our way of addressing the infrastructural deficit in Nigeria, right? So it will be a tall order to expect the government to put everything in place. So the fund serves as somewhat of a channel through which private capital can be deployed to, you know, build up our infrastructural stock in Nigeria. As you rightly said, you know, the fund size is expected to be about 200 billion naira. And so far, we've raised about 93.7 billion over 8 capital raises since 2017. You know, and we're currently on the road looking to raise additional capital. Now, this fund, as I said, is for infrastructure, and, you know, the infrastructural projects it would be invested in would range from telecommunication towers, which are very important for the telco sector, pipeline networks, gas processing plants, off-grid solar and solar mini grids, and, you know, student accommodation also. And looking forward, you know, we're expecting to be active in the health sector, you know, in the future, right? It's definitely a very unique and interesting asset class, you know, that allows investors who typically wouldn't be able to invest in infrastructure to get, you know, their hands in those kind of infrastructural investment deals, right, through the fund. And given that the infrastructural projects, you know, typically have large asset bases, they have, you know, long-term returns and, you know, consistent and predictable cash flows, you know, investors stand to benefit a world of gain over the long term. You know, also some important facts about the fund, which I think everyone needs to know, that the fund is structured such that, you know, it delivers 100% of its profits to unit holders when we've taken out or netted for operating expenses of the fund. And it has the 18th largest free float on the NGX. You know, these are benefits we can put numbers to, given the fund's impressive, you know, track record. Since inception in 2017, right, the fund has delivered, you know, an overall return of roughly 155%. You know, it has distributed 39.5 billion naira throughout 24 quarterly disbursements, meaning that, you know, if you invested, say, 100 naira in 2017, by now you would have recouped, say, 89 naira already, and that's quite impressive.
All right, not a bad one. Talk to me quickly now about the backers of this fund and how you expect it will impact the Nigerian economy.
Okay, so you know, NIDF is backed by pension funds, sovereign wealth funds, development finance institutions, you know, qualified individual investors, right? You know, the AFDB is part of the institutions rather backing the fund. Roughly 96% of Nigeria's pension fund administrators are, you know, invested in the fund. 23 out of 24. You know, and those that aren't in the fund due to related party, you know, reasons. You know, and we have the NSIA, which is the Nigerian Sovereign Investment Authority, as a cornerstone investor in NIDF. Right, what the caliber of these institutions, you know, speaks volumes to the tangible development impact and the ability of the fund to generate predictable and consistent returns.
Looking out to how investors actually react to this fund. Thank you so much, James Ola, this financial analyst at Chapel Hill Denham. It was great having your perspective today. Thank you.
Thank you very much for having me on the show.
All right. So now let's look at all the stories now this week. See, the federal government has launched another Sukuk bond, the first under the administration of President Bola Tinubu. The Director General of the Debt Management Office, Mrs. Patience Onia, made this known at the 2023 Sukuk Investors Meeting in Abuja, explains that the bond, which seeks to raise 150 billion naira, is intended to fund the country's infrastructure development. Since its introduction in 2017, Sukuk bonds have provided 742.56 billion naira for the federal government and helped in funding the rehabilitation and construction of roads covering 4,000 kilometers across the country. Take a listen.
From 2017 till this date, with 742 billion naira, we've been able to either construct or rehabilitate 4,000 kilometers of road, and I believe about 4 bridges, 3 to 4 bridges. You saw some of those pictures. So there's already evidence to show what Sukuk is doing. And for this current Sukuk, it is no different. It is going to impact on roads and on bridges as well. So it's all about infrastructural financing and infrastructural development.
As Mrs. Patience Oniha, the DG, DMO right there. So that's the show today. Thank you so much for watching. I hope you enjoyed it. And you can watch this again on our YouTube channel. Just flip over to YouTube, www.youtube.com/Channels Television. And from me and the team right here at Channels TVH in Lagos, it's bye for now.